Hello, everybody, and welcome to the show. This is Multifamily Chronicles, and I'm your host, Adrian Danila. This is episode number 40. Today, we have as a guest Peter Richter. Peter is the Director of Investor Relations and Capital Markets with Interwest Capital Group. Welcome to the show, Peter.
Thanks for having me, Adrian. I've been listening to your program for a while. It's really got some great content on here.
Peter, why don't you introduce yourself to the audience to begin with? Tell us a little bit about your background, professional, personal.
Sure, yeah. Personally, I grew up in Philadelphia, moved out to San Diego about 10 years ago. Currently, I am Director of Investor Relations and Capital Markets here at Interwest Capital, based out of San Diego. And I'll give you a little backstory on how I got into this role in this industry. I got my start on the management side of real estate. I began my career with a small company, which primarily managed college student housing near San Diego State University. That's where I really learned the basics, the ins and outs of boots on the ground property management. It wasn't long. I worked there for a few years. The company had rapid growth. And then I moved over to the multifamily side and worked my way up in the multifamily, Class A multifamily here in San Diego, starting as a leasing agent, worked my way up to assistant manager, and then eventually managing my own assets. And eventually I found myself working for UDR, which is one of the nation's largest residential REITs. And I was managing their entire San Diego portfolio, which is all downtown mid-rises and high-rises. The UDR portfolio, this is where I kind of got into the other, investment side of it. With UDR, the portfolio was part of a joint venture with a large life co. And part of my job included reporting to their asset management team at the life co and interfacing with their team. And I really found myself drawn to this aspect of the job, the reporting, the kind of telling this story of the asset and converting it into kind of a financial report, if you will. And I really found myself drawn to this. And eventually I took a job with a local real estate syndicator as their Director of Investor Relations and Asset Management. So kind of stepped away from the on-site management, got into the asset management side and investor relations. And there I really found I had a love for crafting communications to investors, taking the financials and turning it into a story and making it digestible to our investors and partners alike. And then fast forward a few years, I landed here at Interwest Capital, which is also based in San Diego. Really just an amazing company. And I immediately, when I arrived here, felt like I had found my home. So it's been great.
Excellent. Peter, tell us a little bit about your current role with your company. What do you do? What's your day-to-day? Like what are your responsibilities?
Sure. Well, Interwest Capital is a real estate investment firm. Like I said, specialized in multifamily, but we also have some hospitality assets throughout the country. And here at Interwest, I manage investor communications for the company. And I also work on sourcing new equity on both the institutional side and with private investors. So reaching out, building our private investor base, and also maintaining and establishing new relationships with institutional investors. Here at Interwest, we use a combination of institutional investors, some of the largest in the country or world, if you will, as well as individual investors to kind of put together our equity stacks.
Would you like to share a few great things that are happening currently at Interwest?
Yeah, so last month, we just closed on an amazing property, a 539-unit Class A multifamily and mixed use in San Antonio. Really a uniquely designed property, close to some of the region's largest employers, and really, it's truly a beautiful asset. And we're also working right now, getting ready to finalize the financing and start a development here in San Diego in a cool little area called North Park. So we're building a 136-unit LEED certified platinum mid-rise, and some really cutting edge technology, solar panels, this hydraulic lift system for the cars, park, and you come down with your smart key, you hit the fob, and your car is brought on basically a conveyor belt directly to you. So really an innovative project, and we're very excited about it. And we got a tremendous, we acquired the land a little over a year ago and have tremendous cost basis on the land. So it's shaping up to be really present itself as a great success, hopefully. But yeah, it's looking great. So yeah, that development is really what I'm focusing on right now.
Your company is just an investment group, right? You guys don't self-manage. You have third parties.
So great question. We use third-party management companies, and this is the first time I've worked at a company that didn't have an in-house management team. And I will say it's been really refreshing because we get to go into whatever market we want. We don't need to have an infrastructure in a particular market. You and I were talking about Atlanta just now, a few minutes ago. And we love Atlanta. We don't have any employees in Atlanta. We don't have any infrastructure. But what we would do is we would just find the best management company in that area, best in market, and have them manage the asset for us. And we find that we then get to rely and utilize their data, their experience, and their resources in a particular area, which has really helped out big time.
We're talking about operating third-party and operators, right? Multifamily operators. One of the biggest challenges that multifamily is facing currently is the shortage of labor, qualified labor, personnel, talent. Obviously, when you're short on talent, then this reflects on the property performance typically. So it makes it harder to operate, and you might be losing some revenue out there, or making less profits. From an investor standpoint, Peter, how do you approach this challenge, and how do you work and help the operators that are managing your assets to overcome the issues of a staff shortage?
So, although as I previously mentioned, we don't manage in-house. We do have an asset management team in-house, which are a really talented group of individuals, pretty much all whom have backgrounds in property management, and they manage our property management teams as well. So what we've seen is that specifically the maintenance side of it has been, I would say, disproportionately affected by the personnel shortages. It's really resulted in, we have to be a lot more competitive with compensation. It's slowed down some of our renovations when you have turnover, and you need to bring in a new maintenance manager to oversee those renovations. Kind of starts back at the beginning. So it's sometimes has slowed down renovations. So ultimately, it's extended the renovation timeline and also eroded a little bit of operating margins because we have to get more competitive with compensation because of the shortage. It's also, I would say, it's made us hyper-focused on selecting the right people for the right job. And I think that's really evident, again, in the maintenance side, where our asset management team, although we have third-party managers, when we're hiring for a position like a maintenance manager, which is a relatively important role, we interview them too here. And we make sure that we believe that they're a good fit. They're not somebody who's going to leave in 6 months. They are happy with what they're being paid, and they're fulfilled with the challenges and opportunities within that job, that role.
So in other words, if I'm getting this right, your involvement today in a current environment, it's a lot more hands-on than it used to be a few years ago.
Sure.
Am I correct in saying that?
Sure, 100%, especially on the personnel side. And, your original question was, how does it impact operations from an investor's point of view? I think when you're investing, you need to now look at the expense line item of compensation and realize that historically companies usually grow that about 2 to 3% annually. That has now stepped up to 3 to 5%. So again, you need to keep in mind when you're underwriting a deal or a new investment that there's a good chance with the current personnel shortages that your compensation expense is going to grow a little bit faster than historical.
I'd like to get your take on the compensation aspect of recruiting and getting talent. The way I always looked at the situation, especially with maintenance that you just mentioned, and my background is mainly maintenance.
Mhm.
I came up in maintenance in the industry, is that what would it take for us operators or for us uh, maintenance maintenance managers to say, okay, can the investors look at increasing the pay as an investment in their business? In other words, let's say that you will invest on a 1 year period. You have a staff of three maintenance professionals on one of your properties. And if we were to pay, let's say, 20,000 more or 30,000 more, like 10,000 per employee per year, if we get the right employees, these people could bring us returns that are probably like 5 times or 10 times more. That's a real situation. People that know what they're doing, they will
Oh,
save you a
definitely.
lot of money.
Mhm.
Yeah, is that something that you would consider in the future, or you are currently considering? Like,
Oh, I would say absolutely. I think that in this market, you have to be willing to pay up for a higher skill set. For example, if you have a maintenance manager who also understands pool maintenance and you're willing to pay him an extra $8,000 a year, than someone who has the same experience but without who doesn't really understand how to maintain a pool. Pool maintenance can cost you $1,000 a month for the third party. So now, if you can do that in house, I think that it's really the higher skilled employees can and rightfully so command a higher wage. And I think that when you look at employee turnover, I mean, as you know, as a manager, I know you've been through it where you hire someone new and you guys start back from zero and they're not able to do stuff on their own for months until you really train them. And there's a cost to that because now you're training them instead of doing something else. So I think absolutely I think it's become somewhat of a eye-opening realization for the industry as a whole that people need to be paid fairly. And from an investor's point of view, it might be a little bit more difficult to make a deal work because you have higher costs, but it feels right. It feels like people should be paid for their skill set and the value they're bringing. And I think we've seen it across the board. People have stepped up. We've seen maintenance teams and, office teams, leasing teams, they step up and they're willing to work harder, smarter, learn more. I mean, on-job training and education is a huge component. And, you can even factor that into the compensation package. But if you can get a HVAC certification and you tell an employee, hey, we're going to hire you and we're going to invest and get you certified, for HVAC certification. Now you're bringing value to them and they're bringing value to you simultaneously. So I think it's kind of been great in that sense that it feels good that people are being paid more and bringing more value to their roles.
that's truly amazing to hear from an investment angle, because I always struggle with the fact that I wasn't sure like what the investment side of business thinks. I occasionally spoke with individuals that were in your position or higher. It's just that I always really wanted to get that angle, the investor's standpoint, and I always had trouble accepting, I guess, the fact that there's not typically, right, there's not enough money out there to pay someone a higher rate, someone that's gonna save you tens of thousands of dollars, short term, mid-term, long term. It's kind of that saying, we're gonna be penny wise and dollar foolish. So I'm very
exactly.
I'm very excited to see that there's a shift in in the approach from an investor's standpoint, because if you're driving that type of that type of approach, management is gonna fall in line. I don't think they're gonna be unhappy to have more money available to hire the right people, the more qualified people. So that's quite excellent. That gives us hope.
I really think it starts from an investor point of view prior to acquisition. When we're doing the underwriting and we're modeling out the performance of an asset, we are now including higher compensation in our budgeted, in what we're modeling out in the underwriting. And if the deal doesn't work because we're paying somebody a little bit extra, then the deal doesn't work. But we're not here at Interwest. We would never. We're very discerning on the deals we pursue, and if it doesn't work, paying somebody a good salary and reinvesting in them through education and training, then the deal doesn't work for us. We're not trying to, like you said, was it penny wise and dumber, I think is the expression, foolish. That's not something we would ever pursue. We would rather, that's not the area where we want to cut back. If that makes sense.
It makes a lot of sense, and I think it's really a healthy way to look at things. Because what I've been seeing, especially with COVID and inflation and everything, that's affecting the labor force, and it's eating off their buying power. Right there, it's been for the most part disheartening. I had to be completely honest with you and say there's no way we're going to be able to keep personnel that's not paid what they need to be paid. And when I say what they need to be paid, it's not just looking at the property next door, what they're paying. There's just so much competition out there. You have to look at the economy in general, at the entire market. Sometimes we're neck and neck as a property management industry. We're neck and neck with warehouse workers. So if someone has a choice to pick between a warehouse job in a controlled environment inside, no on call, or do the same thing, or do maintenance, bring their own tools, be on call, be outside in the elements, I think the choice is pretty obvious. So then in order for the industry to compete with that, and also, you have the gig economy where people make their own schedules and everything. There's just so much out there. Like, how are we going to compete? How are we going to get, decent professionals to take care of the assets? And again, this makes me very, very hopeful. Approaches like your companies, I think they're seeing, they're having the right approach for the present and also for the building for the future.
Yeah, and I kind of went over my background was on-site property management. I was in the trenches many times with the maintenance team working on, those fire alarms that happen when you're on site. And a lot of the people here at Interwest have a background in property management on site. So I think that changed our perspective a little bit, because we know when you have to turn a unit in 3 days, the stress that can put on a maintenance team. So it kind of gives us an advantage in some ways.
Yeah, I could see a bright future right there into this type of approach like your company. So I could certainly, I'm excited to follow your group in the future, because I think there's great things that are going to come out of that with that approach. Like, I really do believe so.
Thank you. We hope so.
Peter, current interest rates, they evolved. It's not necessarily a good thing. They went up and up and up. They're going up. Feels like every day they're going up. How are they affecting multifamily investing?
They're having a tremendous effect. There's a lot less transactions going on. If you speak to multifamily brokers, I mean, some of them a lot of them have a lot of free time on their hands now. But they're also getting very creative. So I have to tip my hat to them. But as interest rates go up, it devalues real estate. In order to get returns, you have to have basically it's created this cap rate expansion, where cap rates were historically in some markets we're looking at 3 or even sometimes below 3. And the idea was that you can borrow money at close to 3% and grow the rents, and all of a sudden you have a positive leverage scenario. You were able to go in with negative leverage and soon develop positive leverage as your yield was higher than the interest rate. Now, with interest rates moving up, cap rate has expanded. And going in with negative leverage is really a thing of the past from day one. And because of this, cap rates have expanded, and that brings valuations down. Additionally, a lot of people in the industry value add has been a very popular asset class. You go in, you fix an apartment, renovate it, increase the rents, and either sell it or refi. A lot of times firms have been using floating bridge debt to get those renovations done, and then they replace it with long-term loans. what happens is now they got that floating bridge at 3% or 3.5%. And as interest rates spike up, so does that interest rate. They're having trouble refining, and it's creating some turmoil in the market right now. We're seeing valuations come down. Some people are in positions where they're scrambling, but it's just starting. But yeah, it's had a tremendous effect.
So I'm assuming what you just explained with the interest rates that has a change in the investor preference too, right? Probably. Could you elaborate on that? How does that change the preference and the investor behavior, I should say?
Sure. I think those heavy value add property investments I was just referring to, they have really taken a back seat now to core and core plus assets, really as a defensive play. A lot of people are expecting or witnessing a recession of some type. And you've got a lot of deliveries, a lot of new supply in markets. So the idea is that you want to have a quality asset. People are moving away from the heavy value add lift, the older properties, the 70s, 80s vintage, to 90s and 2000s, and a little bit less risk on the business plan. Instead of doing a giant renovation, maybe just what we have a term here, restore to core, where we buy core plus assets, do light renovations, maybe a tech package, and bring it back up to core, and be able to present those apartments at a competitive rate. So yeah, we're seeing a lot more defensive investing, I would say. Stuff when you sell it, let's say you're selling in 5 years, you can still say this is now the next person has a bit of a value add opportunity on it. But we're not taking that operational risk right now.
Peter, what do you see from a occupancy, rent, collections standpoint? What type of trends are you seeing in the markets currently, in various markets that you're operating in?
Sure. I'd like to preface this by saying we work in a pretty wide variety of markets, from the East Coast to the West Coast. I would say the degree of impact really varies market to market, but overall, there's been a general winding down of that momentum we felt over the last 12 to 18 months, where vacancy was at all-time lows, rent growth was double digits. We're seeing definitely that winding down as far as occupancy and rent. Collections, it's interesting. Markets that struggled with collections during COVID, that had real challenges, are still having challenges. We look at Vegas, for example, was a tough one. Whereas other more established, I don't want to say more established, other markets where collections weren't as much of an issue. Obviously, there's some volatility during the pandemic. People were waiting on rent relief, or people were temporarily out of work. That's kind of gotten back to normalcy in those markets. So it's really market dependent, I would say. And we're anticipating a slight decrease in occupancy and a deceleration in rent growth in the coming quarters and maybe the next 12 months. We think that as people either are now out of work or inflation is hitting their pocketbook, historically, this type of constrained economy has led to less household formation. So instead of moving out of your parents' house, maybe you stay longer. Instead of branching out from your roommate, maybe you keep a roommate. So instead of having two households, you've got one. And we see household formation slowing over the next 12 months. And our hope is that creates a pent-up demand that in 24 to 36 months is kind of released and creates outsized growth again.
It's very interesting that you're mentioning this. I have a couple of investments myself, and I'm seeing the tendency when my applicants are coming to apply for apartments, that they're actually you could see that there are two families together applying for one apartment. Yeah. My apartments being 3-bedroom apartments, so they could accommodate a larger number of people. Two families of two is not an issue. So beforehand, a family of two will just rent an apartment for themselves. But with everything that's going on out there, people are getting more rent conscientious, and they're just trying to live within their means more, and you save more eventually. And so
it's interesting you mentioned that, and this is getting a little bit granular and a little bit speculative, But I'd say that 3-bedroom apartments in markets like this become often increase in demand, because instead of 3 individuals all having 1-bedroom apartments, now say, all right, let's just team up, let's all move into a 3-bedroom. So I think for that kind of sector of the, those floor plans, I think that they're going to do well. Whereas studios, expensive studios and 1-bedroom specifically, might be more impacted.
Yeah, it only makes sense.
Mhm.
Only makes sense. Peter, the next topic I wanna discuss with you is ESG, as it relates to either the investment side or the multifamily operational side. I know that your company is big on this.
Yeah.
Would you please take a little time to explain what ESG is it, and how how is your company what's your company's approach in regards to ESG?
Sure. Well, I think also relating back to compensation and how it's kind of refreshing to see compensation moving to providing people with livable wages. ESG is another one of those subjects that we're very passionate about here, and it's like about time. ESG stands for the environmental impact, the social impact, and the corporate governance of a corporation, of a company. Now you're seeing more and more capital, specifically institutional capital, being directed by ESG. It's really directing the flow of capital. So certain funds will only invest in ESG compliant or ESG investments that have an ESG profile. And on the operational side, again, it's challenging, right? So first, environmental. So what is the environmental impact of the investment? I spoke about the development we have going on right now, which is LEED Platinum certified solar panels. We have low flow plumbing appliances. So really trying to reduce the environmental impact at every stage. We actually, that property I didn't mention, we've got a few Teslas that it's an Class A apartment that residents are going to be able to use, so they don't have to have a car. They can use our electric vehicles on like a ride share. It's pretty cool. But so that's really the environmental side. The social side is really, it's really dynamic, but I would say on the operational side, is, are you impacting your community in a good way? For example, that development, I'm going to keep relating back to that, I apologize, but we have an affordable housing component. So we're offering a portion, we dedicated a portion of the units to become BMR, below market rate, for people who might not be able to afford those. San Diego has this housing crisis, it's so expensive. So this provides housing to people who might otherwise not be able to afford it. And we've got credit reporting that we're going to be doing there. So for people, and we're rolling that out across our portfolio, but trying to create more economic inclusivity by, especially in workforce housing, allowing people to use their rent payments as credit to build their credit. That's one example. And so, the social impact of the operations in the corporation as a whole, and how diverse is your employment base? Do you have a diverse board of directors? And are you being socially conscious? We do volunteer events here at Interwest, and I think that it's really changing the way people look at their social impact. And governance, it's a little bit more straightforward. It's how ethical and transparent is the governance of the company? What is the decision-making process? And that gives, by making that governance more transparent, it gives investors, gives them peace of mind, knowing that you don't have one person at the top, one rogue person who can, sidetrack a whole business operation. But it's been great. It's ESG is something we're passionate about. We're still developing it here. I'm very involved in it, and all my coworkers are very passionate about it. But it's great. It's about time, like I said.
Peter, now we're at a point where I'm going to have some rapid fire questions for you.
Sure.
Ready?
Let's go.
Books. What are your favorite books? Fiction, professional, nonfiction?
admittedly, I much prefer reading fiction. I like the classics. I like Ernest Hemingway quite a bit. For Whom the Bell Tolls. I recently read a book called Shantaram, which I would suggest to anybody who wants a great adventure book about a guy in India's kind of subworld. It's an amazing book. But Shantaram would probably be one of my favorite books. And then again, the classics. I just finished Atlas Shrugged by Ayn Rand. Great book. So on the professional side, probably the book that's had the biggest impact on me is a book by Dale Carnegie called How to Win Friends and Influence People. And really, it's just a great book. I think anyone whose job or wants to interact better with other people should read it at some point.
Thank you for sharing with us. Next question, Peter. How did a failure or an apparent failure help you build future success?
Yeah, I got a great one. I'll try to keep it brief. It's a bit of happenstance, but I was managing a high-rise downtown San Diego, and I was approached by another company, and they recruited me and gave me a job offer, and it was more than I was making and a great opportunity. I accepted, put in my notice, and 2 days before I started, the owner of the company decided to hire a family friend, and they rescinded my job offer. And I went back to my previous employer and said, hey, this is what happened. And they said, look, we already hired somebody for your old role. So overnight, I was out of a job. And it was devastating, but I worked hard and I kind of focused on myself. And within a few weeks, I got in touch with UDR. And they recruited me to take over a property here in San Diego. And it was probably one of the best things that ever happened in my career. UDR was an amazing company. And I was able to rapidly kind of ascend the ranks there. So, yeah, I was really, I was pressed for a little bit. All of a sudden didn't have a job, and it happened so quickly. But yeah, it all worked out.
I love stories like this because I always tell people, look, when a door closes, you don't know how many other doors will open for you.
Exactly.
It's maybe a sign that you're not being sidetracked. You're just being redirected.
Absolutely. And I think that adversity kind of forces people to recalibrate and refocus on what's important to them and where they actually want to be going. So I think that, yeah, that stuff stinks and it hurts and it can knock you down emotionally, but it's really an opportunity. Now you got your back against the wall, not a whole lot to lose. Pick your track.
Yeah, but how beautiful it is when you overcome and you look behind and you say, wow, I did it myself. How much does that, boost your confidence in yourself and make you proud of yourself?
Impossible to measure how much it improves your confidence. I remember the call when it was a long interview process with UDR. I was in an airport coming back from a wedding, and I got the call from the recruiter saying, hey, we're going to be offering you the position. I had to put it on mute, and I screamed in the airport. I thought I was going to get arrested or something. I was so happy, and that was probably one of the best feelings in my professional career.
Peter, what advice would you have for someone, a young person, ready to enter, the real world, get a job, be out there, make the best for themselves right out of school?
Well, let's assume they're 22 years old. I would really say the first 5 years, you're going to be figuring stuff out. But have fun, go travel, put yourself in as many diverse situations as you can. And that diversity of experiences will help you down the road. And then maybe work for a little bit, save up some money, and then take 3 months off and go backpacking, or if you love skiing, go get a job at a ski resort and ski your brains out. You'll be able to find work later on, trust me. And if you're smart and you've got a college degree, you'll be able to find a good job and build something, but you'll never be able to be a ski bum in Colorado again. Or I went backpacking through South America and, on a shoestring budget with a couple of my friends for about 8 months. And it was the best experience of my life. And I wouldn't trade that for anything. And now I have that with me forever. So I'm married now. I can't just take off for 8 months now. And then once you start your career, I would say get in early, leave late, and just work as hard as you can and dedicate yourself to the company that you're working for, to your employer. Also, advice I always give people is find some allies within the company. Find a couple people who have been there for a while and just do whatever they want. And just let them know that you've got their back and they will help advise you, and it'll become somewhat of a mentor-mentee relationship by default, and they'll help guide you through.
I love this piece of advice. It's pretty much, do the jobs that, other people don't want to do.
Yep.
Volunteer to do it. That's going to create a lot of leverage for you.
Absolutely. Absolutely.
Yeah. Peter, in the last 3 years, what new belief, behavior, or habit has improved your life the most?
Honestly, probably getting up early and working out. I'm embarrassed to say, I kind of took that hiatus from fitness. I used to be in good shape, and then I didn't work out for probably like 6 years. And recently, about 3 years ago, I started getting up and just finding time to get some fitness in my life. And by doing that, I feel sharper. I have more energy. I feel more motivated. I feel generally more positive about myself and confident. And just fit in some kind of physical activity, whether it's a run, even if you're just doing push-ups in your apartment, or if you can get a gym workout in. But it's amazing what it does to your overall perspective. It's how you feel, your mood.
Yeah, I do a little bit of exercising myself. I get up 4:30 in the morning before I even start my day. My work day, I walk for like 75 minutes, and I've been doing this for a number of years now. It literally just keeps me alive, keeps me together. So it's that important to me. Literally, I think if I wouldn't do it, I'll die in a few years. Like I feel that way. It's that extreme of a difference that makes for me.
It really does. And just health-wise, your mood, your emotions, it helps control them. And people are very busy, right? We're all very busy. I think that starting off, if you haven't been doing it for a while, dedicate 15 minutes, 15, 20 minutes. Yeah, I'm going to get a workout in. We're not going to give myself any excuses. If I have to get up 20 minutes early or go to sleep 20 minutes later, I'm getting it 20 minutes less of TV. And then you start working your way up. And like you said, I think they say that a habit takes, 28 days to form or 21 days to form. At this point, I'm sure if you didn't do it, you'd feel, almost lost in your day. It's because it's become habit, where now it's not even like a chore. You want to do it.
I actually feel guilty when I had to miss a day here and there. I'm occasionally missing, but not many days. When I do miss, I kind of feel guilty. Like I haven't done that. I should have made the time. I should have done it. And then, that motivates me for the next day not to miss it. I better not miss it next day. So you're right. Habits are very powerful. Once you get to the point where you build them, like it's kind of like on an automated pilot. You don't even think twice. You just get up there, get dressed, and do it. And it's so amazing how it changes your life.
There's a book called The Power of Habit, I believe it's called, that I read a while ago that one of my bosses gave to me. And, it talks about those positive habits, but also how easy it is to develop negative habits, whether that's coming home and immediately having a drink or, needing a sandwich for lunch, whatever it is. You get out of those negative habits and you kind of break those away and try to instill some positive habits. And sky's the limit.
Very true. Between that and spending extra time, investing in yourself.
Absolutely.
Sky's the limit, really. You're off to the races.
Yeah.
Peter, when you feel that you're losing focus, you feel overwhelmed, what do you use to get back on track? How do you get back on track?
I don't fight it. If I do a lot of writing in my job, whether it's investor correspondence, investment memos. If I feel I'm distracted, I'll get up, go for a quick walk. and then come back. If I try to fight it, then the work I produce is lower quality. So maybe that's not how maybe some people are able to, just block out an hour, but I generally can't spend a full hour and a half or something doing one task. I need to get up, clear my head, switch to a different task, and then circle back. Especially if the task requires creativity. If I'm just working in a spreadsheet, I can, keep going. But when it requires some creativity and some complex thought, I get up, go for a walk, grab a cup of coffee, make a quick phone call and then come back. And I come back with a fresh set of eyes almost.
Excellent. Thank you for sharing. It's very powerful, especially for creative minds. Like you said, you can't just force creative. Like it has its own mind, its own flow. So Peter, was great having you here. We're unfortunately approaching the end of our conversation for today due to time reasons. But I'd like to give you the opportunity. I'd like to give you the opportunity to say something that, I guess answer a question that I wish I would have asked. I didn't. Or just say something that matters to you, it's important to you. And then secondly, what are some ways for our audience to get in touch with you? They want to network, they want to contact you.
Sure. Again, my name is Peter Richter. I am the Director of Investor Relations and Capital Markets here at Interwest Capital. If you'd like to get in touch with me regarding future investment opportunities, we are open right now and accepting new investors. You can reach me at peter@interwestcapital.com or go on our website. There's a contact us form. I think ultimately we are at a very interesting time that, I've only been in the industry for about 10 years, which puts me, I haven't really been through a full, downturn or this kind of volatility. So we are excited for opportunities, yet we are being very defensive. And I think for everybody out there, this is an exciting time, interesting time, and keep your cards close and power through.
Peter, thank you so much for accepting my invitation for being a guest on our show right here. I had a really great time chatting with you today.
Thank you.
I hope to do a follow-up episode sometimes in the future because there's just so much more. It's very fascinating. Your side of the business is not understood by many, and I say mainly I'm coming from the operation side. I like to educate myself, and I'm sure that many on the operation side do not really understand the investment side. So I'm trying to bring this to the show. So this was very, very educational for me, and I'm sure for those that follow. So I thank you again for coming. I appreciate you taking the time to share your experience and your knowledge with the audience right here.
Thank you for having me, Adrian. It's been a pleasure.
Everybody, this is Multifamily Chronicles. I'm your host, Adrian Danila. This was episode number 40. I hope to see you back here. Have a great day.